Welcome back to my channel, everybody. Thank you for tuning in. And in this video, we're gonna go over and break down the best time frames to use and the best time frames basically to trade with, how to enter and exit on what time frames. This is a common question that I get asked on my Instagram when I post charts on a daily basis. I get asked, what time frame are you looking at? What time frame are you looking for entries? So if you aren't following my Instagram, I'm going to link it in the description below. You could ask me questions on there. I post daily trade recaps, so it's definitely worth a follow. But going back to the time frames, you have to be flexible when going through your time frames. You're going to be able to find key price imbalances throughout all different time frames. You might be able to find an imbalance on a 30-minute chart, and you might not even see that imbalance on a 2-hour chart. So you have to go through the list. I'm going to explain the time frames I look at, and I'm going to also explain the time frames that I make the trades off of. So I chart every time frame. Like I said, I'm going to go through the list. But for trading entries and exits for my executions, whether it be day trading or scalping, I'm looking at a 5 or 15-minute time frame for confirmation for my entries or exits. Only the 5 and 15. I don't go anything lower and I don't go anything higher. I don't use a 1 minute, 2 minute, whatever. You can find imbalances on smaller time frames, and it depends on your trading style and your personality. But for my trading strategy for finding imbalances and trading off of supply and demand, I only use a 5 and 15, and I chart looking for key price levels and key price imbalances using a full list of time frames that I'm going to explain right now. Okay, so going to my list of time frames, I have a bunch of favorites here, and these are the time frames that I do use. So let me pull this up. So I have a 1 minute, but I actually do not use this, like I said, so I'm gonna delete that. So I have a 5 minute, a 15 minute, 30 minute, 45 minute, 1 hour, 90 minute, 2 hour, 3 hour, 4 hour, daily, weekly, and monthly. The time frame is the only thing that matters. The day time frame to it, so if it's a 90-day, 180-day, 5 day, that does not matter. It's just the time frame from an intraday perspective that's what matters. So what I do is when I chart, I start at my monthly, then I go to a weekly, a daily, a 4 hour, 3 hour, and I go down the list looking for different price imbalances. And I'm going to show you exactly what I do look for, as if I'm charting on a normal day, looking for price imbalances to play off of. Okay, so the chart that we're currently looking at is a 30-minute chart. And the zone that I want you guys to pay attention to is this 4-hour supply zone that formed yesterday in the overnight session. Now, on a 30-minute chart, you're not going to really be able to see the basing out period that I want to see, followed by a nice drop to the downside. Now, if you go through your time frames, on a 30-minute, you could kind of see that the price was sideways consolidating. So if you're able to spot consolidation balanced periods on smaller time frames, all you have to do is work your way up and start looking. So now we get into the 1 hour chart, and now this is getting tighter and tighter, followed by a nice drop to the downside. So I'm still not there yet, have a 2 hour, and now it's starting to look really good. Now this drop looks completely different than what it did on a 30-minute. So I'm gonna go back to the 30-minute, and this drop right here looks completely different now as what you would look for on a 3-hour chart. So now I have a proper basing period to play off of, followed by this valid drop. So this right here constitutes as a valid 4-hour supply zone. Now the demand that we bounced off of today was on a 3-hour chart that formed from the session Monday morning. Now, if we go to, let's say, a 1-hour chart, we're not going to properly see a basing out period, right? So we see a move down, up, we don't see that basing out period as we do on, let's say, a 3-hour chart. And we could see it properly here where we based out and then had a nice move to the upside, which caused of about a 100-point rally. So this constitutes as a very strong demand zone because this is in an area where the market was then balanced. When the market is balanced, I stress this all the time, you have market participants agreeing on price. Smaller time frames, you're not going to be able to see that. Extend it over and we wait for price to first trade in the zone, and price then aggressively dropped into this zone and then relief bounce away from this zone. Now, from an intraday perspective, right here, this pink box up here from this downtrend resistance was a 1 hour supply zone. So we based out on a 1 hour time period, and then we had a nice aggressive drop. You're only going to be able to see the drop on a smaller time frame chart, such as a 15 or a 5 minute. So here's the drop and here's the basing out period. Price then rallied into the zone, and now you use a 5 or 15 minute chart for confirmation. So here is the same zone. Price then first time traded in it, rallied. You could have taken it short, then boom, price rejected the supply zone, dropped all the way into right down here, which is another demand zone, confluent with a higher time frame, which was a 3 hour demand zone. So not only did we have a 3 hour, but we also had a 5 minute demand zone. When demand stack, that is double confirmation. There's confluence between the levels, and that's just telling you, hey, this is a stronger level. Then price bounced off of this zone, actually created new demand, rallied back into supply, and rejected a downtrend resistance line. And then boom, we sold off, broke low a day. And then yes, we did bounce off of this demand zone again, but I wouldn't have taken this entry because as demand zones get broken, the chances of them working out are much, much lower. But we were confluent with a downtrend resistance line. Okay, so now what we're looking at is a monthly chart going back 20 years. Now, monthly is pretty much one of the highest time frames that I'm going to look at. And no, nothing's going to really change from today to tomorrow. The candle hasn't closed yet until the month is over, and you're not going to really be able to spot basing out periods on higher time frames until we get the closing of that time frame that we're looking at. So we're looking at a monthly time frame right here, and I want you to keep this Trump, this is November 2016 when Trump became president. I want you to keep this level in mind. Whereas on a monthly chart, it just looks like a straight rally to the upside, no basing out periods. It was just a straight rally to the upside. Now, if I go to a weekly chart, let's see if we see it on a 3 year. So let me make it 10 year for this case. We have a solid now rally to the upside, but now we have a basing out period. And this is at the same time that Trump's presidency began. This is the election time, and this is when the market started really pushing for that bull run. Fast forward to this demand imbalance. So now we have a news catalyst on top of a demand zone that formed, and price back in March with the coronavirus when the numbers were skyrocketing and everybody was so fearful. We actually bounced perfectly at that Trump level, which was confluent with a weekly demand zone. Now, like I said, if you go even to a higher time frame in this case, you're not going to see that basing out period at the purple box. You go to a daily chart, so now you go to a smaller time frame. Let me make this a 5 year. You go to a smaller time frame, you are going to see the basing out period, but not as clear. This looks like just a dip down followed by a rally to the upside. We don't really see the picture that we saw on the weekly chart. So that's what I'm trying to get the point out, is that on different time frame charts, you're going to see different pictures. So it's important to go down your list. Price with higher time frame charts, higher time frame price imbalances act like magnets. Think about it. If a stock is basing out for a week period, we're balanced for a complete week. You have a mutual agreement between buyers and sellers for a weekly time period. Think about how many orders and think about the accumulation that gets done during that period. So here we have a supply zone, and really you're not going to see it as clear on a daily time frame. It just looks like a move up followed by an aggressive move to the downside. When I see something like this, it puts a red flag in my head because I've been, so used to seeing these zones not perfectly on the time frame that I'm trading off of. So now I'll go to a higher time frame and see if I see proper a basing candle. So now we have the rally to the upside followed by that aggressive drop to the downside, which is much cleaner, and this will qualify as a supply zone. Price proceeded then to drop, relief bounced into this weekly time frame, and then we rejected it to the downside as price rallied, picked up more sell orders that caused the sell imbalance on the weekly time frame. Think about it. This candle that started on January 22nd was a week time frame. Next week, we had an aggressive, violent move down, and then the week after, another one. This qualifies as a perfect supply zone that we take short once price moves back into the zone. So this is the same weekly time frame, and I'm going to show you now how to use your 5 and 15 minute charts for confirmation. So if I go to a 5 minute chart, Actually, let's go to a 15-minute chart. Let me make it a 10-day. And I'm going to show you this pink box is when price then first hit that imbalance on that weekly time frame. So price rallied, and now this intraday chart is going to show you what it looks like when we first hit that box. 15-minute. So we rallied, and now this is why, you could have a weekly supply zone or a weekly demand zone, but I still use a 5 or 15-minute for confirmation. And when it rejects at the beginning of the zone, the chances of it working out are much higher. So we could have shorted here. We could have saw this massive drop, started breaking a trend, higher lows. Anything that's really signifying on a 5 or 15-minute chart that that sellers are stepping in, higher volume, a supply zone forming inside of a supply zone. Anything that's telling us sellers are stepping in is your indication to take it short on a 5 or 15-minute. You have confirmation on 5 and the 15-minute on both time frames. That is double confirmation. So now here are my other charts, and this is an example on Tesla. So let's just act like we're going through our time frames, and we could have seen Tesla had a major move up. We don't really see anything on a weekly, maybe down here before the rally to the upside. Well, let me go to a daily, and now what I'm seeing is a nice rally to the upside, followed by a 1 day, 2 days, 3 days of basing out, balancing action after a nice rally. When you have, stagnant waters like this, that's just saying a bigger move is ready to come. Then, the next day we had that straight rally to the upside. The next day after that, another massive rally. So this right here caused about 400-point move to the upside. This is a valid demand zone right here. So now, we have our demand to play off of. If I go to a 15-minute, we hit the demand the first time today. We had a nice lower wicks. This is a trade that you should have taken off of this demand zone. Go to a 5-minute, it's going to look completely different. But then towards the afternoon, we bounced off of this zone perfectly, and we rallied 40-something points. Another stock is on Roku. So Roku, nice rejection the other day. Started your weekly, you don't see or your daily, you don't see anything on the daily. All you see is a wick right here. So keep in mind this 3-hour supply zone. All we see right here is a wick. I can't tell anything that there's a supply imbalance up there until I go to a smaller time frame. Now I'm on my 4-hour. Now I see a nice drop right here, followed by a basing out period. This qualifies as a 4-hour, and I bet you if I go to a 3-hour, yeah, it looks exactly the same. So we wait for price then to first trade at that zone. I'm going to go to a 5-minute chart, and let's see what happens when we first touch the zone. Rallied. We hit the zone, 3-hour supply zone, and rejected. Look at that. This is an indication sellers are stepping in. You take this trade short off of a 5-minute as your confirmation, even though it is a 3-hour supply zone. Same thing on NVIDIA. NVIDIA had a 4-hour supply zone. We wait for price to trade there. You could look at a 5 or 15-minute, and this is your trade you have to take short from the first time that price reacts to that zone. Nice rejection off that, about 9 or 10 points. So that would have been a good trade too. So it's just, spotting higher time frames, even spotting lower time frames, and playing off of them. So 5 and 15-minute for entry and exits. I even have a scalping method with a 5-minute chart. You don't have to use a 1-minute or a tick chart to scalp. I use a 5-minute and it works very well. If you understand supply and demand, you have to use all these time frames. They give you a bigger picture, and you might see different things on other time frames, but that's the whole point. You use different colors when you're painting a picture. It's the same thing. You have to use different time frames for you to get the full picture to express itself.